Right. Good evening, everyone. Welcome back to the second session for Mac4865, where we are focusing on valuations, looking at the January-February 2022 paper. All right. We're also going to look at the June 2022 paper. Right, and then we'll go back to the assignments. So those are the 4 papers that we're going to look at, right? Most of the other videos with revisions I've shared with you. If you do not have them, please let me know so that I can share with you in order for you to go through those videos and practice that we've done before. So that at least you get an idea of where we're coming from and where we're going, right? Now I'm going to read, allow me to sit so that I read this and then we can go to the board. Okay. Now, question 3 consists of 2 independent parts. Part 1 or part A reads, Vivo Freight Limited is a JSE listed company that specializes in transporting consumer goods within the Southern African Development Community countries. The company's directors are considering making an offer to purchase an unlisted transport company, Tokai Transport Limited, Private Limited, that transports goods where the business is similar to that of Vivo Freight Limited. Tokai Transport will continue operating as a going concern as it currently is, should Vivo Freight succeed with the purchase. The directors of Vivo Freight Limited believe that there will be a significant synergy between the entities, which will be seen in the financial results in the years to come. An excerpt or extract of the 2021 financial statements as at 31 December are as follows. So I've got assets, equity and liabilities, right? Can we go to the next page? Profit and dividend information, we're given net profit, then dividend, net profit, and dividend. All right. And these are in thousands, which means 571.5 thousand and 64.4 million, right, in 2017 and thereafter. Vivo Freight Limited has 1 ordinary share, 1 rand ordinary shares, and Tokai Transport has 50 cents ordinary shares. That's the nominal value of these shares, right? Tokai has several private individual shareholders that own all the shares. The managing director, also the founder of the company, pays himself a salary that is at least 240,000 rand a year, more than a market-related salary for someone in his position. Should the shares of Tokai Transport be purchased, his salary will be adjusted to the market-related rate. Included in the PPE of Tokai Limited is property that is overvalued by 2.5 million, right? Also included in property, plant and equipment is plant and equipment which currently operational and in use that are worth 1.5 less than its current book value if it were to be sold as scrap metal. About 600,000 of inventory is obsolete and could be sold as scrap for 120,000. Vivo Freight Limited shares are currently trading at 2,675 cents. That's 26 Rand 75 cents. All right. Per share ex div, that is after dividend. A suitable cost of equity for Tokai Transport is estimated at 13%. The directors of Vivo Freight Limited indicated that the PE ratio of Vivo Freight should be used as proxy PE ratio when valuing Tokai Transport. Next page. Vivo Freight Limited has debt covenants relating to its bank loans. Vivo Freight Limited is only able to obtain an additional 10% of financing based on the current bank loans before these covenants are breached. All right. Assume an income tax rate of 28%. Right. Write a memo to the financial director of Vivo Freight where you calculate a range of values. For Tokai, provide a range of values in the memo using the following valuation methods, right? So firstly, the net asset valuation, right? Then the dividend valuation, then earnings valuation. Okay, right. Now, before we go to the theory, let's look at the calculation first. Okay, you can stop sharing. I'll use the paper here from my phone so that my board can be visible. Okay, so I want this to be very engaging in such a way that everyone gets an understanding of how to calculate these using these valuation techniques. All right. Now, when we are looking at the net asset valuation model, right? Can you see my board? Can you see what I'm writing? Can you guys see what I'm writing?
Yes, we can.
Okay, thank you. So we are given information that is useful for all three valuation techniques, right? But we need to select the information that's relevant to this particular valuation technique, right? Now, the starting point is to understand what is the net valuation method, net asset valuation technique. What do you think we should look for? What should we look out for?
The assets and liabilities of the company.
Yes, Nothando are using two gadgets. I think you should stop using the other because
No, my computer only became active now, so I've left the phone now.
All right, thank you. All right.
So
we look at assets and liabilities, right? So we are saying to get net assets, we say it's total assets minus total liabilities. Is that correct? Do we agree?
Yes, we agree.
Okay. Based on the information that we are given, right? Total assets sit at 26,938,000 minus our liabilities, which are, we skip share capital, right? Do you agree?
Yes.
We skip retained profit. Do you agree?
Agreed.
And then we take 11,560,000 plus 7,123,000. Do you agree?
Yes.
Now the question is there any other information that you think we should take into consideration?
The property, plant, and equipment that was overstated.
Okay, by how much?
Like 2.5 million.
So what do we do with that information? What is its effect? Overstating property, plant, and equipment has an effect on the net assets. What is the effect of overstating property, plant, and equipment?
We have to reduce it by the overstated figure.
You're not answering my question. What is the effect of overstating property, plant, and equipment on net assets?
It overstates our net assets.
So what do we have to do then? We have to subtract it, right?
Yes.
Then what else?
The plant and equipment.
Yeah.
The plant and equipment under PPE.
What happened to the plant and equipment?
It's less than its book value.
By how
It's
much?
worth less than its book value by 1.5 million.
So we have to deduct 1.5. Then what else? What is this that I put here?
Isn't that the adjustment for inventory?
It is, but why?
Because it's obsolete. Saying 600 of the inventory is obsolete, so you then say 600 minus 120.
Yes,
So that's what you subtract.
correct. And what do we get?
Get 480.
8 like this.
Oh, sorry, I was calculating the the inventory, the 600
Oh, okay.
minus.
That gives us 480, right? But I mean the balance, the total. What do we get here?
I got 21858.
21. 21.
858.
85.
8.
Like this.
21858 million. 21858.
I don't think that's correct.
I got 22.
22.
458.
I don't think that's correct.
Total asset. It's only total asset.
Do you see my calculation on the board?
Monasha, sorry.
Yes.
I think I included receivables and cash, so we should not take that into consideration.
What do you mean?
Remember, we got the total assets,
Mm-hmm.
and then we had to subtract the PPE,
Mm-hmm.
and then also the inventory.
I'm not asking about why would we deduct the inventory? Because we're taking over the business as is. So are we now saying we are not taking over the inventory or the cash?
No, the difference of the obsolete inventory, didn't we subtract that as well?
Why should we subtract inventory?
Okay, I think maybe we should. I think that's where I got a challenge. So the inventory should be part of the asset that we acquiring, right?
Is it not part of the assets that we are acquiring? Is it not part of the business?
It should. It should be. But which part of, do we take out the obsolete part of the inventory?
We took out 600, but there is a salvage value of 120,000. So the difference of these two amounts is the 480,000.
So how do we treat the 480,000?
We deducted it here. So I was not asking you to give me your answer. I was asking you to give me the answer based on this calculation you see here. And this is what we get.
Oh, yes, because that also includes the liability.
Of course. Any questions here? All right. Now keep that figure somewhere. I want to use the very same board. I want to clear this and use it to calculate the next valuation technique, which is the dividend valuation model. Right. Dividend valuation model. How do we calculate the dividend valuation model? Anyone?
I think we use the M&M model.
The M&M model. School me. What do we do here?
So it should be PO is equals to D1 over cost of equity KE less growth.
So is this what we call the M&M model?
I'm sorry, it's not the dividend valuation model.
What do we call
Gordon.
this?
It's the Gordon.
Gordon's
Yes, the Gordon
dividend valuation
model.
model. Right. Okay, so I see my space is not going to be enough yet. So I'm going to use the next board. Now, based on the information that we have, what should we do? What's the first step?
We should calculate the dividends per share or in total.
Now, for things to be easy for you in the exam, what do we need to first establish here?
The growth, maybe?
The growth, that's correct. With the information at our disposal, how do we determine the growth?
G, it's equals to RB.
Sorry?
G is equals to RB. Where R is the cost of equity.
Okay. And B?
And B is the The earnings minus dividends, I think. Then net profit. Divide by the earnings again.
Net profit divided by earnings.
No, it's net profit minus dividend divide by net profit. That should be our B.
So earnings over dividend over earnings.
Yes.
What do others think of this? Any thoughts? I think the challenge here is you are complicating things. So this is incorrect. G is very simple to find. Now let's look at our dividends. Now in 2017, the dividend was 571.5. Then 2018, it was 650. 2019, 650. 2020, 706.9. 2021, 777.6. Therefore, there is no consistency and there is no sound dividend policy. Now, in situations where there is a dividend policy that perhaps stipulates a percentage of the earnings, the growth will be equal to the growth in earnings, right? In a situation where there is a constant growth in dividends, that constant growth becomes your G. However, in this situation where there is no consistency, right, you apply time value of money principles, right? Where the present value is the 2017 dividend amount, right? Are we together? The future value is the 2021 dividend amount, right? And N is the number of years between 2017 and 2021, which is 4. Compute I, this becomes your growth. Simple, right?
So it's 8%.
Is it 8%?
That's what I got.
Yes, it's 8.
All right. Let me also calculate, right? I got 8%. So that is correct. So what's the next step now? After establishing our growth? So now we do have certain variables, right? We have KE, right?
Yes.
We now have G, right? What do we not have? We don't have
Dividends.
D1. So we calculate D1. So we come here, PO is equal to 777.6 multiplied by 1.08 divided by 0.13 minus 0.08. Then we get our D1. Am I right? And remember, it's now 16,796,000, right? 100 and, am I right? 160. That becomes the value of this company. Are we aligned?
Yes.
Just simple stuff, right? All right, let's go to the next method. The next method here is the earnings valuation. Now, what is the earnings valuation? What is the earnings valuation?
Is it where we calculate the value of a company using the price earnings multiple?
Yes, that's an earnings valuation model. And what's the price earnings multiple here?
It's the price per share over total earnings. Oh, total, it's a share price over total. Right.
Yes, that's correct. So PE ratio is equal to market price over earnings right? What is the market price? So we have been told that we are going to use Vivo's PE ratio to calculate the other company's price earnings multiple, right?
Yes.
Of which Vivo's shares are currently trading at 2675 cents, which is 26 Rand 75 cents multiplied by the number of shares that Vivo has, which is 75 million. Am I right?
Yes, that's right.
This gives us this gives us 2,006,250,000. Right? I wonder what the former president would have said there, maybe, and you know. Right. Then we divide by the earnings. What are the earnings there?
It's 143,300,000.
And we get 14. Are we aligned?
Yes.
I'm just going to use that side of the same board. However, we now need to adjust the current earnings of Tokai. The current earnings are earnings for Tokai 1,258,400 rand, right? Then adjust for salary. There's a salary that is above what it should be, which is 240,000. Do we add this or we subtract it?
We add it back to earnings.
Yes, we add it back to earnings because it would have, what do you call it? It would have reduced the entity's earnings. But that's not the only thing.
You need to adjust it first, don't you?
No. It's fine that way. We adjusted it already. You mean to adjust the earnings, right?
No, as in like the salary, wouldn't it need to be adjusted for tax?
Yes, you are right. You are right, actually. Right? So it actually is 240 divided by 0.72. Am I right?
Yes, that's right.
Because the tax rate is at 20%. Gives us 333,333. Right? What else is there to adjust? I think that's the only thing, eh? Then we look at adjusted earnings. Sorry. Am I right? PE multiple of 14. So we now multiply and get our value there. $22,284,262, right? So the range of values is from 3,775,000 to 22,284,262. All right. Now let's go to the theory. Any questions up to this far? All right, may I erase this? Right. So these are the range of values we found, right? Now let's look at the second part of the question, right? The theory that we are supposed to address. Right. With reference to the range of values calculated above, advise the board of Vivo Freight Limited as to how much it should offer to Tokai Transport Limited's shares and evaluate and recommend the form of consideration for the purchase that would be appropriate. Anyone? How much? Okay, what should we consider? What should we consider?
You mean what to offer them? Or-
Yes, yes. What should we be looking at?
The net asset valuation would not be accurate, so that can be taken out.
Why? You cannot just say it won't be accurate. Why do you say it won't be accurate?
Because it usually gets used during liquidation processes, and it doesn't take companies that has intangible assets into account.
But this company does not have intangible assets. And remember, for companies with intangible assets, we use the CIV to determine the value of the intangible assets. So your line of argument should raise this concern. The net asset valuation model, right, like what you've said, is normally used for a company that's undergoing liquidation, right? However, in this case, Tokai is a going concern and is solvent because the net assets are positive and therefore the company is solvent, right? Therefore, the net asset valuation technique would not give a perfect and clearer picture of the entity, therefore should be disregarded. Let's go to the next one. The dividend valuation model Any thoughts? Ms. Maluleke, your thoughts? Come on, guys. Farai? Any thoughts? Likopo? Yeah, I have a quiet room today. Okay. We are looking forward to acquiring a majority stake, right, in this company, right? But the dividend valuation technique is mostly used where an organization, right, is solely dependent on dividend distributions, which means it is useful when only we want to acquire a minority stake and do not have control on the future sustainability of the organization and therefore should be disregarded. Am I making sense?
Yes, you do.
Do you see my line of argument? I'm looking at the technical aspect and I'm applying it to the situation at hand. Now, the earnings-based valuation technique is the most appropriate valuation technique simply because we are acquiring a majority stake in this entity and therefore we do have control over the earnings of the entity and the future of this organization. Therefore, the value that we are going to take is 22,284,262 as the value. Now, the question goes further to ask us to evaluate and recommend the form of consideration for the purchase that would be appropriate. So what forms of considerations can we use? To acquire a company, we can either use cash, perhaps equity, meaning we finance the acquisition with our own liquid money, or debt. We borrow in order to pay, right? we can use an issue of shares or a combination of both. Now we are evaluating, right? Which means we look at pros and cons of each of these. Are we together?
Yes.
Right? Not only do we look at pros and cons, we also look at our situation as an organization. Where are we? We look at our statement of financial position. We have 62 million in cash. Our own money. Right? And we are sitting at a situation, if we raise this 22, we are not able to raise, okay, we can still raise perhaps 9%. They said if we raise 10% of 314 million, right, which is our current bank loan, we are going to breach the loan covenants. And this amount is 22. So we can still borrow, right? But we are looking at a situation where if we take out 22 million from this, we still have got about 40, close to 40 million remaining in our account, right? But we need to consider the fact that we may want capital expenditure and operational expenditure. Are we and our current gearing, we're looking at a gearing which is close to 50%, right? But if we issue shares, it means that we are diluting our control. Do we need to do we want to dilute control or not? So with this kind of discussion, there is no solution, but it is based on your evaluation, and your final recommendation does not really matter. However, my recommendation is we do have a lot of disposable cash. So rather pay these guys cash, they walk away, we take over the company, and we run it using cash, our own money. we don't have to borrow, right? And we do not want to dilute control. Any questions?
Munasha,
Yes, Tando.
would it be safe to say we can maybe do a combination of the two, but to maybe make a majority of the amount in cash and maybe 20 or 30% to borrow so that we can benefit from tax?
That is your professional recommendation, and I like it. So you're talking about tax benefits. Also, remember, we can take all debt because only if we borrow up to 31.4 million, right? But we still want to benefit in terms of tax without breaching the debt covenants. So we can still use debt, the full amount. But it's all your professional judgment and whatever you decide, as long as you argue your case. And that is why if we give one CFO to run an organization, right, compared to another CFO, the decisions may differ, right? And the progressiveness of the organization may differ as well, right? So perhaps we do have more capital investment projects that are in the pipeline. Then we don't have to use our own cash. Rather, we borrow, pay, right? And use the 60-something million or part of the 60-something million towards acquiring more trucks. Or we can use that money to diversify so that we minimize our risk exposure. Do you see how simple it is? Please share again the script, the paper. Then we go to part B. Okay. Now, your work is you guys are going to write for me. When is our next lesson? Tomorrow. Is it tomorrow based on the timetable? Guys, when is our next session?
It's tomorrow.
Okay, great. So I want you to do question tomorrow from what time? Is it 8 or 9?
9.
Okay. So I want you to do question 2 and 4 tonight. Then we're going to look at these tomorrow together. Question 2 and 4. Okay. Let's look at question 3, part B. Please share the script. so that we read it from here, and then I'm looking at the time now. We may not have the time to review each person's script, but we're going to surely finish the 12 marks here. Okay. All right, I'll start reading from here while you're sharing, right? Zwingli Limited has prepared a bid to acquire Siabuswa Limited. Both are listed companies. The directors of Zwingli Limited would like to know the value of synergy post-acquisition of the combined company. The net profit of Zwingli was 70 million and 9.5 million for Siabuswa Limited just before the takeover. The PE ratios being 14 and 9, respectively. After the takeover, it is expected that the market will assume that the management of Zwingli will be able to apply a common approach to both companies after the takeover, where the performance of Siabuswa will be improved to the same level as Zwingli Limited before the acquisition. All right. In addition to this, additional savings relating to operational costs are expected to amount to 2 million after tax in the combined company. The directors of Siabuswa Limited have indicated that the bid received from Zwingli Limited is seen as a hostile takeover bid, right? Using the bootstrapping method, calculate the value of synergy, if any, in the combined company post-acquisition. So what we want to calculate here is the value of the synergy, right? Not the value of the company. Are we together? Then briefly discuss 3 relevant pre-bid defenses and 3 relevant post-bid defenses. Okay, we can leave this one out, right? Okay, but let's calculate the value of the synergies here. We've got Zwingli and Siabuswa, right? Let me do this. What are the profits?
It's 70 and 9.5 million.
PE multiples, it's 14. And 9, right? So the values here right? These are the values post-bid. Am I right? So the total is 1,065,000, right? Sorry, 1,065,500,000. Right? So now, the profits post-bid, here it remains 70 million, right? And here it's now 70 million. Am I right? Times 14 times 14 gives us 980 million. 980 million to give us a total of 1,960,000,000. We get the difference here. We get 894,500,000, but it doesn't end here, right? There's more information that has been given. Savings of 2 million. Then it gives us 896,500. This is the value of the synergy. Simple calculation, right? Any questions? All right then. Now it's time for you to do question 2 and question 4. All the best with your evening. I also still have a lot of work to do, which will make me not to have a good night's sleep tonight. But anyway, thank you so much for today's session. Please do those and send me. We will do the entire review of your scripts tomorrow. Remember, theory is also important, right? Thank you.